What if I told you that Chinese banks are desperately pumping out billions of dollars in phantom loans? We're talking fake credit that never touches real businesses. They're doing it just to hit bogus government targets amidst a crumbling economy. Now forget everything you know about banking, because this is straight up cooking the books to mask a deflating mess. Now, credit is the lifeblood of any debt-fueled system, and this screams at all those rate cuts, stimulus packages, and liquidity floods that I said wouldn't work, and now there's evidence they're not. Now stick with me here, because we're about to dive into how China is teetering on the brink of an economic abyss and is primed to drag the entire global economy down right along with it. Now, speaking of opportunities amidst this chaos, there's one sector that I see as the absolute best as we head into the end of the year. Now, I tipped off my CTA Time Pro subscribers back on the 7th, and that trade is now up already 5.46% in a mere 3 days. And it's not too late for you to jump in, because the machines haven't started their massive short covering yet. Now, to get on board with my trading group and in on this trade before you miss out, grab those links in the description below and use the coupon code for your free trial. And stay tuned to the end of the show for more information. Chinese banks are scrambling to cover up this frightening truth. They're teetering right on the edge of insolvency. Loans are turning sour left and right. We're seeing consumers and businesses alike that are not biting on new borrowing. And the whole economy, it continues to grind slower and slower despite all of these repeated stimulus shots and liquidity floods by the PBOC. Now let's paint the picture, because these banks are literally begging clients to take out loans and pay them back immediately, with a bank even covering the interest cost. Now this is a shady practice, and it's not new. It's called quick lend and recover, and it's all about faking the numbers to look good on paper. And what they're actually doing is the banks are hiding the ugly truth about China's economy, because they can make funds cheaper and more abundant, but they can't force people to borrow, spend, or invest. And that matters big time, because credit expansions are what fuels economic booms. And Beijing's pulling every lever to flip the slowdown around, and none of it's working. Now stick with me on this relationship, because credit downturns, or even worse, full contractions, straight up drag economies right into a recession. Let's take a look at this first chart of commercial industrial lending versus real GDP in red. And I want you to see, as credit slows down in blue and ultimately goes into contraction when it falls below that horizontal black line, what happens to GDP? It follows right alongside it. And you can see this relationship going into every recession, and the risk, at least where we're at here in the US, credit is at a contraction, suggesting that GDP growth is headed down in the quarters to come, the US economy falling right alongside China. So you can see how clearly they track together, because when lending dries up, growth tanks. Now let's zoom in on China, because when you look at this chart of China's loan growth, it's slowing to a record low of 6.4% year on year. That's the worst since 2003. So now you can see why this makes perfect sense, why China's economy is headed into a recession, and why ours is too. Because there's not enough new money sloshing around or being created to service the mountain of debt that's been created over the last several years. And on top of that, there isn't enough money to spark real growth. And that's why these recession vibes, and you're hearing about it almost every day, are hitting hard. Well, what was Beijing's fix to all this? While targets vary from bank to bank, they've been told to lend at least as much as last year. And since real demand is nowhere near that, it's pushing the banks to whip up these phantom loans out of thin air. And looking at this chart of household debt, you can see that Chinese households, they're borrowing less too. So people don't borrow money when they're worried about losing their jobs. That's what's happening here in the US, because if you don't have a job, you can't repay your loan. And here's the proof. Let's take a look at the second chart of commercial industrial lending, still shown in blue, against the unemployment rate, now shown in red. And you can see very clearly, as the unemployment rate rises, it puts downward pressure on lending, because businesses don't want to borrow and consumers can't borrow because there aren't any jobs. And that's the risk we're facing right now, is we haven't seen the unemployment rate skyrocket higher yet, but based on what we're seeing in commercial lending, any further slowdown threatens to unwind the labor market. So as you can clearly see, as global demand falls, unemployment is going to spike and credit will shrink even more. And all those rate cuts, now you understand why. They don't fix it. Because here's the dirty secret that the Chinese banks are bearing, and what I've been hammering on for quite some time. They flat out stop lending when delinquencies start climbing. Here's the proof. Let's take a look at this next chart of commercial industrial lending, still shown in blue, against a delinquency rate on all consumer loans. And what you can see very clearly, as the delinquency rate rises, of course, consumers can't access new credit. Banks certainly don't want to extend it. And what happens? Next thing you know, you see lending enter a contraction. And you see this repeat cycle after cycle every time delinquencies rise. And so where are we at here in the US? Well, we already know that delinquencies are expected to go higher. And so that's exactly why the PBOC's liquidity injections aren't flowing into loan loans. They're just getting parked in bonds instead, and for good reason, because the banks don't want to lend. They're worried about getting their money back, so they're choosing safety. That's why they're buying government bonds, despite the fact the government's telling them not to. So let's dive into just how bad this situation is and why China's on the brink of a banking crisis that could pull the entire world down with them. And despite all of these repeated stimulus blasts, liquidity floods, and interest rate slashes, nothing is budging because China's economy is still stuck in the mud and it's getting worse. Now, why are businesses shying away from borrowing? It's simple, and it's everything to do with crumbling global demand because China's manufacturing machine leans way too heavily on the rest of the world. And between this slowdown and the ongoing trade wars, they're taking a brutal hit. In fact, exports fell in October for the first time in 8 months, dropping 1.1% from a year earlier. Shipments to all nations except the U.S. rose 3.1%, not enough to compensate for the more than 25% decline to America. And if this drags on, and all the evidence says it's going to, what it means is more loans are going to go sour, and you can see why the banks are just slamming the brakes on lending. It doesn't make any sense to do it. But demand's only half the story here of why businesses aren't borrowing. Because China's services activity expanded in October, even though growth was the weakest in 3 months, as holiday spending and travel by households supported the industry during a deepening economic slowdown. Now, sure, okay, services ticked up a little bit in October, but here's the key part. The growth was the weakest in 3 months, and it was all propped up by holiday spending and travel. So what happens post-holidays? Well, you're staring at an economy that's drowning in debt, and growth is grinding to a halt. Or even worse, what we're seeing here is something called stagnation. So if you're betting on services saving the day, now think again, because remember, where manufacturing leads, services falls right behind. As the official PMIs last week showed, manufacturing and construction in China both slumped. So you can see China's economy stuck in stagnation, parts of it continuing to decline, and now you start to get the clear picture of why banks don't want to lend and why they're teetering on the edge of a financial crisis. But let's talk about the elephant in the room here, because the real estate developers, well, they're bleeding out and in a big way. China's Vanke's bonds slumped after a state-owned shareholder pressed it to secure earlier loans with collateral, tightening financial terms just as the developer reported a deeper third quarter loss. The company says its largest shareholder, Shenzhen Metre Group, has requested collateral or pledges for 20.37 billion yuan worth of previously unsecured loans to ensure repayment. And so you start to understand why banks are faking these loans. It's because the PBOC is breathing down their neck to hit targets. But with property prices in free fall, they're facing a massive margin call on this developer debt that I don't think is ever going to get repaid. So this isn't just phantom stuff. What you're seeing is China's entire banking system is teetering on the edge of collapse. And now you start to understand that why is the PBOC out there trying to shove yuan borrowing at anyone, anywhere, because it's a Hail Mary to internationalize a currency in the hopes to bail out their banks. The country will promote the role of the yuan as a funding currency as one of the key steps to advance its internationalization. The central bank pledged to support the use of a variety of funding products, including yuan loans, panda bonds, offshore yuan bonds, and trade financing to help make it easier for overseas institutions and corporations to obtain the currency. But here's the kicker. The yuan's cheap borrowing costs have become the new selling point. And again, you have another reason why the banks are terrified to lend, because they're already dealing with razor thin margins. And that leaves banks with no room for error if things start to default, because you get one wave of sour loans and they already can't cover the hit. So Beijing's fix, hey, let's dangle even cheaper credit around the world and pile on more risk to the banks if borrowers flake. So you get why these banks are hoarding those PBOC liquidity injections to buy bonds instead. They crave that safe capital and guaranteed interest that they are not certain they can get by lending money out. And on top of this, they know the PBOC is in complete denial here. Global lenders like Goldman Sachs retracted calls for further monetary stimulus in China this year after the central bank telegraphed more patience in steering an economy still on track to hit growth targets. But come on, do they even believe what they're saying here? The banks are out faking loans and the PBOC is pretending a turnaround's coming. And yet, you look at manufacturing in China, it's in a multi-year slump. The services sector is stagnating and the global slowdown is starting to pile on and accelerate. And all this is doing is putting pressure on banks, not just in China, but all over the world. So check out this chart. The experts are betting on PBOC cuts, and the evidence, it's screaming for it. Because when credit slows or contracts, slashing interest rates is the go-to move by central bankers. But as you can see in this next chart, it doesn't work. Let's take a look at commercial industrial lending. Again, still shown in blue against the federal funds rate in red. And you can see as lending decelerates and ultimately contracts, what is the response by central bankers? To cut rates, because their opinion then is the reason we're seeing a deceleration is because rates are too high. The problem is you notice that as loans contract, the banks cut even more. It makes no difference until you hit some rock bottom level. And that's the risk we're right now with the Fed. They're way behind the curve. So is the PBOC, in fact, every other central bank. But you can see now why they dive bomb into big rate cuts when lending contracts, because they're praying that it'll spark borrowing and lending. But the ugly truth is after massive credit binges and growth spurts, you need an endless expansion just to service the debt and hit targets. And that's one of the reasons we have recessions and even worse financial crisis, because you have too much debt and not enough growth. And that's exactly where we're at now. And then what happens? Well, as things slow down, the delinquencies start to rise. And if the central banks aren't aggressive, you can kiss your entire banking system goodbye. And again, that's the risk we're facing all across the world. So what the PBOC is blind to is China staring down another recession barrel, and the banks are terrified that they're the next to fail. So here's the bottom line, my friends. This phantom loan fiasco just isn't some isolated glitch. It's a canary in the coal mine screaming that China's debt-riddled system is cracking under pressure, and when it snaps, shockwaves are going to hit us all. Now expect the PBOC to cave soon despite whatever they're saying here. Look for them to cut rates and push the yuan overseas as much as they can. But mark my words, it will not stem the tide if global demand continues to crater and delinquencies continue to pile up. Because what we're talking about is a complete banking meltdown. Now, don't sleep on this. You want to protect yourself. I want you to consider diversifying out of your China-exposed assets and look to load up on safe haven plays before it's too late. But there's one sector I see as the absolute best trade heading into year end. Now let's take a look at this trade we put out to our CTA Timer Pro subscribers back on the 7th, now up 5.46% after 3 days. And how did we know this? Because we look at machine positioning each and every day in our reports. And what we see here is a threshold level was being broken, and that triggered us to buy. But on top of that, I have fully optimized all of our signals, so we know which of those CTA thresholds delivers the best returns with the best results. And here's the great thing, you can still get in on this trade because there's going to be another big move by the machines coming and you don't want to miss out. Now, how do you sign up? Well, all you have to do is grab those links in the description below and be sure to use that coupon code for your free 30-day trial. And what do you get? You get the tradable signals. You get my opinions on the best trades. All of them optimized, fully back-tested. You get risk control levels, a full tracking of all our open trades and returns. You get a weekly update. And again, best part of all, you get that 30-day trial. So whether you're brand new to trading or maybe you're an experienced trader using a lot of other reports, once you see the difference, you're going to see why we have the edge that nobody else does. Again, grab those links in the description below and use a coupon code for your free 30-day trial. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.